History often leaves warning signs long before economies break. Yet those signals are usually dismissed because they appear during periods of apparent stability. Today, the global economy displays one of the oldest contradictions in financial history: record levels of debt alongside claims of long-term control. At the end of 2023, global debt surpassed $300 trillion, more than 3 times the size of the world economy. Historically, debt has never reached this scale without forcing painful economic adjustments. Governments now borrow more during expansions than they once did during wars or depressions. This reversal defies centuries of fiscal logic, where growth was meant to reduce dependence on borrowing rather than deepen it. Interest rates were held near zero for over a decade following the 2008 financial crisis, even as asset prices surged. In previous eras, such conditions would have triggered tightening, not further monetary accommodation. Inflation returned sharply after 2020, yet policymakers described it as temporary, even as consumer prices rose at the fastest pace in 40 years. In the United States, inflation peaked above 9% in June 2022, a level not seen since 1981. Central banks expanded their balance sheets at a historic pace while assuring markets that stability was preserved. Between 2008 and 2022, the Federal Reserve's balance sheet grew from under $900 billion to nearly $9 trillion. Banking systems continued to extend credit even as sovereign debt burdens climbed. This dynamic mirrors earlier periods when confidence masked fragility until stress exposed structural weakness. Currency systems rely not on physical backing, but on trust in fiscal discipline and monetary restraint. Once that trust weakens, stability can vanish faster than policymakers can respond. In past collapses, warning signals were visible but politically inconvenient to acknowledge. Economic history shows that denial often lasts longer than sustainability. What makes the present moment unusual is not any single statistic, but the convergence of all of them at once. When debt, inflation, and monetary expansion rise together, history suggests the cycle has already entered its later stages. Modern financial crises rarely begin with collapse, but with a framework that quietly rewards borrowing over restraint. This framework has repeated across centuries, changing form but preserving its underlying mechanics. At the center of the cycle is sovereign debt, created when governments spend more than they collect in revenue. Borrowing fills the gap, postponing consequences while increasing future obligations. As debt grows, governments rely on banks to absorb and distribute that borrowing. Banks, in turn, expand credit by lending multiples of their reserves, increasing money-like claims throughout the economy. Central banks sit at the core of this system, setting interest rates and providing liquidity. When rates are lowered, borrowing becomes easier, leverage increases, and risk appears deceptively manageable. Over time, low interest rates change behavior rather than merely supporting growth. Governments delay fiscal discipline, businesses chase cheap financing, and investors accept lower returns in exchange for perceived safety. Debt accumulation accelerates because the system rewards expansion more than caution. Each new unit of debt requires continued growth or refinancing to remain sustainable. When growth slows, central banks often intervene to stabilize the system. This intervention usually takes the form of asset purchases, which inject newly created money into financial markets. Historically, these actions were constrained by gold reserves or fixed exchange systems. Once those constraints were removed, monetary expansion became limited primarily by confidence. Inflation emerges when money and credit grow faster than the production of goods and services. At first, inflation often appears in asset prices before reaching consumer prices. Rising prices erode purchasing power, even when wages increase. This creates the illusion of growth while households quietly lose economic ground. As inflation persists, currencies begin to weaken relative to real goods and alternative stores of value. This weakness reflects declining trust in the currency's ability to preserve value. Governments facing higher borrowing costs often pressure central banks to maintain accommodative policies. This tension between fiscal needs and monetary credibility defines late-stage debt cycles. Regulatory frameworks often adapt to sustain the system rather than correct it. Capital rules, accounting changes, and emergency facilities are used to maintain confidence. Banks become increasingly dependent on central bank liquidity during these periods. What begins as support gradually becomes a permanent feature of the system. History shows that debt cycles rarely end through deliberate reform. They usually resolve through inflation, restructuring, or crisis-driven adjustment. The critical factor is timing rather than awareness. Policymakers often understand the risks, but delay action due to political and economic costs. Confidence holds until it doesn't, and shifts in sentiment can occur rapidly. Financial systems built on leverage respond poorly to sudden loss of trust. This framework has repeated across empires, nations, and monetary regimes. The names change, but the sequence remains strikingly consistent. Understanding the pattern does not prevent it from unfolding. It only allows observers to recognize where the system sits within the cycle. What matters next is how this framework behaved when tested under real historical pressure. That test is recorded clearly in past economic collapses. In the aftermath of World War I, Germany emerged burdened by debt, reparations, and a shattered productive base. The Treaty of Versailles in 1919 imposed payment obligations that far exceeded the country's capacity to generate revenue. By 1921, Germany's government faced rising deficits as tax income collapsed and social spending increased. Rather than default outright, officials turned to borrowing and monetary expansion to bridge the gap. The Reichsbank increased money issuance to finance government obligations. What began as emergency support quickly became routine fiscal funding. Between 1919 and 1922, the German money supply expanded several times over. Prices rose steadily at first, masking the severity of the imbalance. By early 1923, inflation accelerated into a feedback loop. As prices rose, tax revenues lost value faster than they could be collected. Workers were paid more frequently to keep up with price increases. Wages rose, but purchasing power fell even faster. The German mark collapsed on foreign exchange markets as confidence evaporated. By November 1923, one US dollar was worth approximately 4.2 trillion marks. Savings accumulated over decades were wiped out in months. Middle-class households, once financially stable, were pushed into poverty. Banks struggled to function as loan values became meaningless. Credit allocation broke down as prices changed by the hour. The collapse was not caused by printing a loan, but by debt monetization under political pressure. Monetary expansion followed fiscal failure, not the other way around. Stabilization came only after radical reform. In late 1923, Germany introduced the Rentenmark and halted unrestricted money creation. Confidence returned not because debt vanished, but because limits were restored. Monetary credibility proved more powerful than sheer money supply. Decades later, a different version of the same pattern appeared in the United States. During the late 1960s, government spending rose sharply due to war and social programs. The U.S. abandoned the final link to gold in 1971. This removed external discipline on dollar creation and exchange rates. Throughout the 1970s, inflation accelerated as deficits persisted. Consumer price inflation peaked at over 14% in 1980. Interest rates were eventually raised above 20% to restore confidence. The adjustment triggered recession, but stabilized the currency. Emerging markets experienced similar cycles under different conditions. In Latin America during the 1980s, foreign-denominated debt amplified currency stress. Mexico's 1982 debt crisis followed years of borrowing funded by cheap global credit. When interest rates rose, repayment became impossible. Banks required restructuring or nationalization. Governments lost access to international capital markets for years. Each case differed in context but followed the same sequence. Excess borrowing led to monetary strain, then currency instability. What matters is how closely present conditions resemble those earlier moments. The same framework now operates on a global scale. Since the 2008 financial crisis, the global economy has entered a phase that mirrors historical debt cycles. Sovereign debt expanded rapidly, with global totals rising from approximately $55 trillion in 2008 to over $300 trillion by 2023. Central banks responded by lowering interest rates to near zero and launching large-scale asset purchase programs. The Federal Reserve's balance sheet alone grew from under $900 billion to nearly $9 trillion during this period. Governments borrowed heavily to stimulate growth and stabilize financial markets. The U.S. federal deficit exceeded $3 trillion in 2020, representing over 14% of GDP. These policies prevented immediate collapse, but encouraged risk-taking across financial markets. Low rates and abundant liquidity inflated asset prices far beyond underlying economic productivity. Household and corporate debt rose alongside sovereign obligations. In the United States, total household debt surpassed $17 trillion by 2022, while corporate debt reached record levels as well. Emerging markets relied on dollar-denominated borrowing to fund development and maintain fiscal stability. When the U.S. dollar strengthened, repayment burdens increased, creating pressure on these economies. Inflation, dormant for decades, reappeared sharply after 2020. The U.S. Consumer Price Index rose 7% in 2021 and peaked above 9% in mid-2022, exceeding forecasts across every major industrialized economy. Global supply chain disruptions magnified the impact of monetary expansion. Shortages of energy, semiconductors, and basic goods amplified inflationary pressures. Banking systems faced heightened systemic risk, despite apparent stability. Large banks reported record profits, but leverage and off-balance sheet exposure created hidden vulnerabilities. Central banks attempted to manage inflation while preserving financial stability. The European Central Bank, for example, maintained a delicate balance between rate increases and bond purchase programs. The expansion of central bank balance sheets has distorted traditional market signals. Government bond yields no longer reflect underlying risk accurately, a pattern also observed in Japan's prolonged low-rate environment. Trade and capital flows globally. Governments continue to rely on monetary accommodation to finance deficits. In Japan, the debt-to-GDP ratio exceeds 260%, yet interest payments remain low due to central bank policies. Debt sustainability is now closely tied to investor confidence and central bank support. Loss of confidence could trigger rapid adjustments, as historical episodes have shown. Global reserve currency status complicates the picture. The dollar's dominance provides flexibility but also hides vulnerabilities that emerge during periods of systemic stress. Financial instruments designed to hedge risk have grown exponentially. Derivative exposures, while meant to manage risk, create opaque interconnections across the banking system. Patterns of debt accumulation, monetary expansion, and inflation mirror historical precedents. The difference today is scale, speed, and global interconnectedness. Policymakers face limited options to unwind debt without causing disruption. The balance between stimulating growth and maintaining credibility has never been more delicate. Economic observers note that the same mechanisms that triggered past crises are present. Sovereign debt, credit expansion, and monetary accommodation now operate together on a global scale. Patterns in financial markets can act as early warning signs. Currency, strength, bond yields, and inflation data provide insight into systemic stress. The modern economy is heavily leveraged but outwardly stable. The stability may conceal fragility, just as it has before in every major collapse. Understanding the current environment requires viewing it through historical patterns. Without this perspective, the repetition of past mistakes becomes more likely. If current trends continue, the consequences for the global economy could be severe yet gradual. Persistent deficits and monetary expansion increase the likelihood of prolonged inflation and currency depreciation. Households and investors may see real purchasing power erode, even if nominal incomes rise. Savings lose value, and long-term financial planning becomes more difficult under a depreciating currency. Central banks may resort to financial repression to contain debt burdens. Policies such as low or negative interest rates, higher reserve requirements, or directed lending could suppress returns while keeping governments solvent. Bond markets may signal stress before defaults occur. Rising yields on sovereign debt, particularly in weaker economies, could trigger capital flight and tighten global liquidity. Emerging markets are especially vulnerable to dollar strength. Heavy reliance on U.S. dollar-denominated debt exposes them to repayment shocks and currency devaluations. Banking systems may face increased fragility, even in advanced economies. High leverage and interconnections mean that localized shocks can propagate rapidly. Credit markets could tighten as lenders demand higher risk premiums. The cost of borrowing for households, businesses, and governments may increase simultaneously, slowing economic growth. Inflation may persist in cycles, even as central banks attempt to combat it. Historical patterns show that monetary tightening often lags behind inflationary pressures, creating volatile adjustments. Social and political pressures tend to rise as economic stress mounts. Inequality, unemployment, and cost of living pressures can influence policy decisions, sometimes delaying necessary reforms. Global trade and investment flows may also be disrupted. Currency mismatches and debt stress in key regions can reverberate across supply chains and financial markets. Debt restructuring could become unavoidable for some nations. Default or negotiated restructuring is historically a common resolution for unsustainable debt burdens. Economic growth may become increasingly dependent on debt rather than productivity. Expansion, funded by borrowing rather than innovation, often proves unsustainable in the long term. The interplay of fiscal and monetary policy will define outcomes. Decisions to prioritize growth over stability, or vice versa, create diverging paths for economies. Historical evidence suggests the system rarely fails overnight. Crises usually develop over years, with incremental imbalances eventually converging into sudden stress. Understanding the trajectory requires vigilance in monitoring fiscal balances, credit growth, and inflation. These metrics act as barometers for the health of modern economies. Global coordination or lack thereof will influence severity. Cross-border financial linkages mean that one country's debt crisis can ripple worldwide. Policymakers have limited room to maneuver in a highly leveraged global system. Unforeseen shocks, such as geopolitical conflict or commodity scarcity, can magnify stress. The current environment demonstrates that patterns from history still apply. Sovereign debt, monetary policy, and banking dynamics create recurring cycles with measurable consequences. History teaches that apparent stability often masks underlying fragility. Economies can appear resilient while debt accumulates, credit expands, and monetary credibility slowly erodes. Sovereign debt cycles rarely end through immediate collapse. Instead, they resolve through gradual inflation, restructuring, or a combination of both, demonstrating that the system adapts under pressure. Monetary credibility, once lost, can take decades to restore. The Weimar Republic, post-war United States, and Latin American debt crises all show that restoring trust is harder than preventing its erosion. Policymakers often act late, constrained by political, social, and economic pressures. History shows that delayed intervention magnifies economic dislocation and social hardship. Global reserve currencies provide flexibility but also conceal vulnerability. The dollar's dominance has allowed extraordinary borrowing, yet it also means that stress in the U.S. financial system resonates worldwide. Banking and financial systems are inherently leveraged. Small shocks can propagate rapidly when confidence falters, turning localized stress into systemic crises. Credit expansion amplifies both growth and risk. Each new cycle of borrowing carries the seeds of future instability, creating a repeating pattern across centuries. Inflation often precedes currency stress rather than following it. Rising prices erode purchasing power and reduce confidence, ultimately forcing policy adjustments. Modern observers must learn to read these signals. By studying historical cycles, we can recognize warning signs, understand potential trajectories, and prepare for likely consequences without relying on prediction. Debt, once thought manageable, can compound silently into systemic risk. Understanding this dynamic reframes how we view policy,